Marcus, you have the slides, right? You have the slides up?
I do have the slides.
Okay.
Yes, sir.
Okay.
And I
Cool.
will
All right.
share them.
All right, everybody. Well, I'm introducing CLA today. They're here to talk some accounting, and Michael Prima and Marcus Bowman are here to kind of get us started and go through a slideshow. And they've prepared a nice little event for us. This has been we're very gracious that they've decided to do this event for us, and I'll just let them kick it off. I guess, Michael, you can start.
Yeah. Hey, everybody. Great to meet you. Look forward to this session and learning a little more about your businesses and ideas. So I am usually in our Denver office. I'm actually in Las Vegas today, but work with a lot of early stage companies, especially a lot of companies going through, their incubation or acceleration phase. And as a firm, CLA, we love startup companies. We love technology, love seeing these ideas kind of come to life. And, that growth, those kind of strides in innovation are oftentimes tough. So we love helping companies through the very critical phase of their existence. Not sure if you guys are familiar with CLA, Clifton Larson Allen, but we're a national firm. I think by last count, I think we're the 8th largest. Pretty unique in the space we play in. We're all about privately held companies and their owners. Don't do a lot of public company work. Again, it's really geared toward private companies and their owners. And like I said, we work with a lot of early stage companies, hopefully through the entire life cycle, from day one up through potential exit or, kind of the next phase of growth. I focus primarily on the tax side of things. Really, I focus primarily within the world of research and development tax incentives, so federal and state tax credits and incentives. Fortunately, there's a lot of benefits to early stage companies from a R&D tax incentive standpoint. A lot of early stage tech companies, can defray income taxes, defray payroll taxes, and we love helping tech companies take advantage of these incentives as a great cash flow tool to, kind of realize for these early stage companies. Marcus, I'll kick it over to you here in a second, but he's in our BizOps group, which is, I think, really a huge differentiator for CLA, especially when it comes to early stage companies. Marcus, you want to?
Yeah, absolutely. Thanks, Michael. And everybody, glad to be with you, and looking forward as well to sharing the time a little bit. Michael gave a great overview and intro to CLA. I am in what we call our BizOps group. It's short for business operations. And we really do everything back office related that you can imagine for small to medium size and even a few large companies. We also do quite a bit of consulting, so we can provide fractional controller CFO services to your business. Most companies, small businesses especially, don't have access to that kind of resource. Certainly can't afford to hire a full-time one in-house, and so we're able to provide some fractional help as needed and help folks as they're thinking about how to grow and scale their businesses. I spend most of my time in this business operations space. I call myself a recovering tax professional. I did practice tax for a good part of the first part of my career. Still do a little bit here and there for clients, but mostly focused on this outsourced accounting and back office framework and space. So with that intro, let me just say a quick word about our presentation today. We do not intend to spend the entire time lecturing, as that's going to get boring for all of you. So we have prepared some slides. We're going to run through them pretty quick. There will be a couple of slides we'll spend a little more time because the subjects are a bit complicated, but I would say we put this together really with the hope of providing a resource, an after the fact resource for you guys, right? So we'll get done talking about this stuff, and then hopefully if you've got questions, we'll have provided you some links, some ideas, some ways to leverage this material into help for you, whether you need us on a follow-up basis or not. You'll have a resource that you can utilize. So that's our plan. With that, I'm going to try to share my screen here. see how this goes. And how are we looking?
Looks good.
Looks good.
We see it all?
Good to go.
Yep. We're good.
Okay, terrific. So this is really, again, it's supposed to be focused on you and your business. So we're going to run through these slides, and then hopefully we're going to have quite a bit of time. We've got, I think, 90 minutes allotted here. We're going to hopefully have quite a bit of time to take your questions. And they can be questions about the stuff on the slides, or frankly, they can be questions about anything else you've got from a tax and accounting standpoint. We're happy to tackle them. So with that being said, just the things we're going to cover in the slides are really making an effort to address questions that we hear from a lot of startup businesses. Okay, so starting out, what kind of an entity do I need, if any? Do I even need an entity to be in business? What's my best play there? How do I know what taxes I'm expected to pay, right? And how in the world would I find out? As you all know, there's a lot of different taxing regimes. And so how do you make sure that you stay ahead of that and don't end up with nasty grams that you got to figure out how to deal with? How about, do I need accounting software? And if I have it, how do I use it? How do I set it up for kind of best effect in my business? A little bit more complicated question, but what kind of a profit could my business generate? Like, how do I go about, particularly if I'm thinking about capital raising, how do I go about projecting what I think is going to happen in my business? Seems like a simple question, but hopefully we can help provide some technique that'll be able to get you rolling in the right direction. And then finally, I want to pay the people that are helping me, but I'm a startup and I can't really afford them. So do I need to give away half of my business to folks in order to compensate them for their services, or what are my options there? So those are the questions that we're going to hope to provide some answers to as we go. I'm going to say a few words about entity choice. Again, intent is not to read the slides. You can read the slides after the fact. But basically, I would say from my perspective, and then I'm gonna let Michael chime in here as he spends some time in this space as well. The end game is kind of the name of the game when it comes to entity choice, right? The question that we're going to ask you, if you ask us what kind of an entity should I be, we might ask, how complicated is your business? How sure are you that you're going to be in business 5 years from now? But if you've got a really viable business or an idea that you think has legs, we're going to be asking, what happens when you get out? What are your intentions with regard to bringing in other people into your business, right? So with that, I'm going to actually kick over to Michael. Michael, you want to elaborate just kind of from your perspective and experience on that question?
Yeah, it's one of the big early stage questions you have to answer is how am I going to set up as a business? And with the understanding that how you are set up today might be very different than how you're set up 5 years down the road. This day and age, it seems that LLCs tend to be the entity of choice, and it's in large part because they're so damn easy to set up, and most people can understand, an LLC, limited liability company, it gives you as an owner, protection from a legal standpoint. So, what I forget what LegalZoom's charging these days to set up an LLC, but it's literally a couple bucks, or you could go on, your state secretary website and set it up in a couple minutes. Very easy to set up an LLC. You only need one owner to set up an LLC, and they're pretty basic, As an LLC, you are essentially, if there's only one owner, for federal tax purposes, you're essentially disregarded. For federal income tax purposes, you're essentially disregarded as a separate entity. So if you have an LLC, you're the sole owner, chances are that activity is actually going to be reported on your personal income tax return on your 1040. That's one of the interesting aspects of an LLC. They're kind of a hybrid entity, right? It's very, very common. I'd say the vast majority of startups especially if you're in your first, couple months, first year or two of existence, you're going to be an LLC. It's very often that you're going to be the sole owner, and this is going to be reported on your 1040. Now, LLCs, if you bring somebody in as a co-owner, that automatically is then going to default to a partnership, okay? And partnerships won't get into deep partnership tax rules. It's frankly a pretty dry stuff, to put it mildly. But partnership taxation is very challenging, but also very flexible. So there's kind of a give take with partnerships. They can be very advantageous. It gives you a lot of flexibility, but the rules are very, very complicated. Definitely something you want attorneys and accountants behind. But if you bring in as an LLC, you bring in another owner and don't do anything more, don't make any additional elections, you're going to default to a partnership, which is a recognized entity for federal income tax purposes, and will now mean that you have to file a partnership tax return, which is a Form 1065. And, if you've got two people, 50-50, it might be fairly easy, but it can get very complicated when you start doing fancy allocations like, hey, we're not going to do things pro rata. Once you start doing things on a non-pro rata basis, partnerships can get very challenging. Now, partnerships are what we call a flow-through entity, as is an S corporation, which we'll talk about here in a second. But as a flow-through entity, it doesn't pay its own taxes. And this is also true with a single member LLC, as I mentioned, it should report on your 1040. This whole concept of flow-through taxation is really, hey, whatever income loss, deductions that are recognized at the entity level, at the partnership level, in this case, they're just going to flow through to the owners, okay? And that is done via what's called a K1, a Schedule K1. And they're pretty detailed. It sets forth all the different categories of what we call separately stated income and loss that you as the individual owner are going to in turn have to recognize on your 1040. So flow through taxation, you've probably heard of this. Most people tend to like it, but you'll see here in a second, once we start talking about the corporate form, especially C corporations these days, the calculus has changed a little bit, and flow through taxation, I think, has been kind of reassessed in the last couple years. The LLC form is interesting in that you, as I said, single owner, typically going to be disregarded. You have two owners, you're going to default to partnership. However, LLCs are able to what we call check the box, right? It's an ability of an LLC to they're kind of like tax chameleons. They could take on a couple different shades and shapes within the tax world. And you can have a two-member LLC that is currently being taxed as a partnership, but you say, you know what? We want to change form and actually be a corporation. And we actually want to be an S corporation. You can actually do that with an LLC. It's literally, it's as simple as submitting some basic forms, checking some boxes. There are, requirements. I'm kind of oversimplifying this, but you can, as an LLC, be a partnership, corporation, and even within the corporate world, you can be an S corporation or a C corporation. So again, they're hybrid entities. So let's talk about corporations. Now, C corporations are their own tax-paying entities, okay? They are subject to what we call double taxation. So all income is recognized at the corporate level and taxed at the corporate rate, which is currently 21%. This was brought down significantly from the former rate of 35%. This was part of what we call tax reform. Technically, it's called the Tax Cuts and Jobs Act of late 2017, and it brought the corporate tax rate down from 35% down to 21%. So income at the C corporation is taxed at the corporate rate. It is a flat rate. And then also, once you take your money out of the C Corp in the form of a dividend or a distribution, it's also taxed again at the individual level. usually going to be subject to preferential tax rates, either 15%, 20% upon distribution. But that's that second layer of tax when we say double taxation, once at the C Corp, once at the individual level that is triggered upon distribution. For many years, we did not like C Corps unless you had to be a C corporation. And you'll see here in a second, there are times where you really do have to be a C corporation. But in general, as tax practitioners, up until a couple years ago, C corporation was typically not going to be the entity of choice, especially for an early stage company, in large part because of that tax rate effect. Pre-tax reform, you had a 35% tax rate, and then also that second layer upon distribution. That changed quite a bit with tax reform, bringing the rate down to 21%. A lot of companies who otherwise, previously would have said, no way, it doesn't make sense for me to be a C Corp, actually might have found a lot of benefit in being C Corp. So we saw a lot of companies, S Corps in particular, going to C corporation status as a result of the rate change. Now, C corporations, they're much more formal. You have to have a board, you have to have meeting minutes. They are, I'd say, a much more formal tax entity when it comes to some of the, as compared to some of the other ones. With early stage companies, it is very often the case that you might be an LLC, but you're taking on some new money, some new investment dollars, and you're going to have to switch to a C corporation. And this is because of a couple different reasons. One of the big ones is you really have kind of maximum flexibility in terms of who you can have as a shareholder in a C Corp. You can have foreign individuals, foreign entities. As you'll see here in a second, with S Corps, it's fairly restrictive. So it's not uncommon at all for an early stage company, taking on some new funding to switch to C corporation status in the process of taking on that new investment. The last entity we'll cover here is S corporations. And from a state law perspective, an S corporation is just a corporation, right? Unless, as I said, you're an LLC that elects for tax purposes to be a corporation and further elects to be an S corporation. But a lot of times you'll see an S corporation is a state law corporation that happens to make that S election for federal income tax purposes. It is a flow-through entity, so similar to a partnership, you've got this concept of separately stated items of income loss, credit, etc., all flowing through to the individuals. Now, one of the big restrictions with an S corporation is who can be a shareholder. And this is one of the reasons why a lot of early stage companies taking on investment cannot be an S corporation. You essentially, I'm simplifying this, but in general, you have to be an individual. There are some very narrow exceptions, but in general, you have to be U.S. resident individuals as shareholders. There are some other restrictions as well. You have to have less than 100 shareholders. And again, have to be, for the most part, a beating heart, an actual individual to be an S Corp shareholder. Now, if you meet those requirements, the S corporation could be a very attractive tax vehicle. One of the other areas you need to think about for an S Corp, especially when you're profitable, is you as a S Corp shareholder that performs services for the corporation, you really need to be taking out wages for compensation, okay? This is something that the IRS for many, many years has actually focused on quite a bit. Not so much for early stage companies, more so for larger, more established, profitable S corporations. They really want to see you taking out a what they call reasonable compensation as an S Corp shareholder. And this is one of the quirks with S Corp rules, that you as a shareholder performing services are considered for tax purposes an employee of the S corporation. Employees are supposed to be taking out W-2s. That's what the IRS wants to see with S Corp shareholders, taking out a W-2. Now, a lot of times that's easier said than done. What is reasonable compensation? Who knows? Never been defined. There are some rules of thumb we use, but it is definitely one of the challenges, or at least requirements, I'll say, when you are operating an S corporation, especially a more mature one that has shareholders performing services for the company. Contrast that briefly with a partnership. It's kind of the flip side. Technically, partners shouldn't be taking a W-2 out of the entity. We see a lot that do, actually, and arguably it doesn't really matter much. You're kind of in the net same position at the end of the day. But technically, from an IRS standpoint, partners are not employees and should not be taking out W-2s from the partnership. Okay. Last one I'll cover here, that first one actually, sole proprietor, that kind of plays into the LLC taxing regime. As I said earlier, when you are a single member LLC, you are often going to be treated as a sole proprietor, in that all that information, all that tax reporting occurs on your 1040. Now, you don't have to actually have an LLC, though. You probably want to. If you're running any sort of business venture, you want an entity. Like, hands down, you want an entity in place. But you technically can operate just personally, just have your name, your social security number associated with the business as a true sole proprietor. Probably still want a separate bank account. And again, very, very inadvisable to be operating without any sort of entity protection, but you can effectively operate as a sole proprietor without any state law business entity set up at all. Marcus, anything you want to add there?
Yeah, I mean, just a question, Michael. So let's say we want to get out, right? So for whatever reason, let's just say we got to a point where we said, we're gonna dissolve the business. We're gonna go our separate ways for one reason or another. What, can you give us a sense of the comparative difficulty of getting out of some of these forms of entities?
Yeah, and that's an excellent point. As I said earlier, the way you are set up operating today might be very different than 5-10 years from now. And as difficult as it might sound to do, you really need to think about possible dissolution or going separate ways from your business partners. Your marriage today might seem great. You're in the honeymoon phase. You've got this great idea, but we know 5 years down the road, you might be at each other's throat and going separate ways from a business standpoint. And it really depends on how you're exiting. You've got various options. Maybe you're buying your business partner out, right? Maybe somebody else is buying your business partner out, in which case there's going to be tax consequences. 95% of the time, anytime you've got somebody exiting a business, there's going to be some sort of tax that is triggered. Usually it's going to be capital gains, which is a good thing, lower preferential rate. But let's take a basic scenario. Let's say we've got a partnership, 50-50, and 5 years down the road, the one partner is going to buy the other out. Okay, whatever the value is of their partnership interest, that at that time, that's what the redemption amount would be, most likely. That's what the exiting partner will be paid in the form of cash, usually, or a note, and that is going to trigger gain to that partner, right? And the gain, basic terminology, is kind of fair market value over their basis. Basis is just kind of tax nomenclature for what your investment is in a particular asset. So whatever that differential is typically going to be gain to the exiting partner. Let's say that a new partner buys one of the partners out. Usually it's going to be a similar type impact from the exiting partner. They're going to be bought out for X dollars, which is, theoretically going to be more than they paid or put into the partnership, though, so they're going to trigger the gain as well. With partnerships, things can get very difficult. There are some really wacky kind of inside and outside basis computations that you have to go through, and we certainly won't bore you with that. But in the case of partnerships, exiting and entering partners can actually create a lot of headaches, a lot of computational pain points, right? Which is one of the reasons why I said earlier, partnership taxation can be very difficult, flexible, but can be very difficult. And that is oftentimes highlighted when you have some sort of ownership shifts happening across partners. But in general, when you when a member is exiting, there's going to be some sort of taxable event. Usually it's going to be preferential long-term capital gains rates to the exiting member. Now, let's take a C corporation. In some respects, it'll be the same situation. You know, exiting shareholder is going to be paying tax most likely on whatever they received for their shares compared to how much they paid for their shares. Now, with C corporations, however, what you'll oftentimes see is a straight up, 100% sale of the C corporation. So let's take this double taxation concept a little further. So let's say that you've got your two shareholders, 50-50, and another much larger corporation says, hey, we want to buy all of your stock. Great. They're gonna, buyer is just gonna pay X for the selling shareholders stock, and they're gonna trigger capital gains upon the sale of their stock. Let's say, however, that the buying company says, we just want to buy all of your intellectual property. We just want to buy the assets of your C corporation. This is where double tax is usually going to be triggered, and very, very significantly. Because let's say they pay $100 for your intellectual property, which oftentimes you really don't have any tax basis in. Whatever your IP is, a lot of times there's minimal, sometimes zero tax basis in that intellectual property, right? So that $100 might be all taxed at the corporate level, 21%. Tax is going to be due on that asset sale. And then again, you want to take that $100 out of the corporation, you're going to be faced with that double layer of taxation upon distribution. So something, you always need to think long and hard about when it comes to setting up the entity, operating the entity, and maybe even switching entity types is, what is my end game, And if, tech, I'm sure there's some software companies on here, tech companies, it's kind of it's an interesting space in that an eventual sale or exit is oftentimes the main goal. It's kind of unique to the software space where you might set up your company with the hope of selling it in 5 years, which is oftentimes very different than your tried and true manufacturing companies, let's say, or hospitality, or food and beverage, something like that, where you have a lot more history and a lot more longevity that you see with the founding group. A lot of software companies like, hey, I've got my idea and I want to sell it to Oracle or Amazon. That's my end game. So it's particularly critical for, I'd say, tech-focused companies to think about that potential exit. Who are you investing with? Who are the owners that you need to, think about 5 years down the road? Any questions there, folks?
Feel free to drop questions in the chat as well to everybody.
Oh yeah, did we?
And we'll have an opportunity to ask as well later on. So for sure, if you don't get them in now, we'll give you an opportunity. So, okay, thanks, Michael. Appreciate that entity overview. And again, you've got the slides here with some of the high points, and we'll provide our contact information, of course, at the end if there's something that we can do to help. So, with that, let's move into the realm of answering the second question that we posed, which is basically, how in the world do I know what kind of taxes I need to be thinking about when I start my business, right? And we're gonna move through these pretty quickly, because what I've done here and what we've done is provided you with a lot of links to kind of go and do a little bit of this research yourself. So really quickly, when it comes to federal taxation, a lot of it is really just about saying to the IRS, like, I've got an LLC, and as you heard Michael say, how do I want to be taxed? Do I want to be a sole proprietor? Do I have a partner or another person in business with me? And if so, do I want to be a partnership? Maybe I want to be an S corporation. Maybe I want to be a C corporation. You kind of get to tell the IRS what it is you're intending to do in the process of applying for your federal ID number, right? So I've provided a link there that you can go and do a little bit more reading about that. A lot of times, again, because this can have implications down the road, we think it's smart to consult with a professional at the front end. It doesn't take a lot of time, but maybe by describing the goals that you have and what you're intended to do, we can make a recommendation for federal tax purposes. Moving ahead to state taxes, and really the state tax realm is where things get a little bit more complicated for a simple reason that there's just a whole lot more taxing jurisdictions to be thinking about, right? And so again, just made an effort to kind of provide you with some links that you can copy and paste into your web browsers later. So you're going to start typically with an entity formation at the state level, right? You're going to tell you're going to form up as a corporation. You're going to form up as an LLC. You're going to just decide to be a sole proprietor. One of those things you're going to do, and so you can see we've provided an entity formation link there for the state of Tennessee. And then once you form that entity, it's going to be about licensing and taxes. And so again, we've got a link here, and if you follow this first link, it literally gives you a list of all of the kinds of taxes that you can experience in Tennessee. It's quite the list. And there's links for each one of them, kind of explaining them. And what we're going to do is just hit some of the high points, some of the more common ones. Depending on what industry you're in, you may have some really specific state taxes that apply to you. An example I always think of is if you're in the beverage industry, specifically the alcoholic beverage industry, there are some special considerations for state taxation typically, and federal as well, for that matter. Also, I'll just point out quickly, and I've given you a link to this as well. There is the Tennessee TAP site, which is super helpful to go and register for these kinds of taxes. So again, just trying to provide you some resources so that you can go and do that once you figure out, which taxes am I going to be subject to, or am I going to be subject to? So then moving on into some of the more common ones in Tennessee, you've got something that they call the business tax, okay? And it's at the state level, can also be at the city level. Again, links, you can read up a little bit about what makes you subject to the business tax. It's a gross receipts tax, can be levied by any municipality. And again, we've provided a link to the list of cities. So if you're doing business in a city, and Nashville is certainly on that list, you're going to have a city tax obligation. It's not a large tax, but it is one that if you don't file, you get a nasty game about. So moving on then to the franchise and excise taxes, this is really for those entities that you form. You're an LLC, you're a corporation, you're a limited partnership, which is something we didn't cover because it's pretty rare that folks form limited partnerships. Sometimes you see it in the professional services realm, so that's where you see it the most. But there's what's called a franchise tax, or a kind of a minimum tax that applies to those types of entities. So if you've got one of those, you'll want to take a look or consult with a tax professional about what you might owe there. Moving on to sales and use tax. And this is one where we could frankly spend a ton of time. And I see I've got a question in the chat. I'll circle back to it here in a second, Michael, or if you want to address it, you're welcome to do that. Sales and use tax applies to sellers of all goods, almost all goods, and even some services. So if you're distributing product within the state of Tennessee, good chance you've got a sales tax collection and filing obligation, right? If you're a wholesaler, so if you're selling to not the end user, but you're selling to a retail, to somebody who's going to turn around and sell your product at retail or combine it with something else and sell it, then you may have a wholesale exemption. Often you have to go ahead and file that sales tax return and then just basically tell the state, hey, I made these sales at wholesale. I didn't make them at retail. Use tax, I'm just going to hit this real quick and then we'll hit some multi-state stuff because I see we've got a question in the chat about multi-state as well. Use tax is really the counterpart to sales tax in the sense that if you buy something that would ordinarily be taxable, let's say you buy it online, right? And this is because of the way our sales tax regime has changed since the Wayfair case. This is less common, but sometimes you'll buy something online as a retail purchase that is for your own use in your business, and for whatever reason they will not charge state sales tax on that purchase. So then what the state of Tennessee expects of you is that you essentially remit what would have been sales tax if it had been an in-state purchase. That is what use tax is in brief. With that, also with sales tax, you get into multi-state issues. Again, this has gotten significantly more complex since the Supreme Court Wayfair case in 2018. Michael, are you answering the questions in the chat? Are you working on that, or should we just address them here?
No,
verbally?
I thought we'd address them, Marcus. I thought it'd be these are great questions.
Yeah, so we'll do that here. This first one, what if you're in here e-commerce business? Do you have to deal with the business tax in Tennessee? So now we're talking about the business tax, not the sales and use tax. Some of these specific questions might require just a little bit more research, but my understanding is if you're domiciled in the state of Tennessee, even if you're an e-commerce business, you're going to have to address that business tax. Whether or not you'll be subject is going to depend on your specific circumstance, but it's certainly something that you're going to have to look at and make a determination whether your gross receipts for your business, your e-commerce business, is subject. And again, that's just based on the fact that you're here in Tennessee, at least presumably doing business, right? Doing a business activity. Does that help?
Oh, sorry. I didn't realize I had my mic on. Yes. It's just I'm currently in the process of starting up a Shopify account where it's purely going to be e-commerce. And so I just wasn't sure what all of the taxes that I might need to educate myself on, or at least obviously hire someone to do when you're not doing like brick and mortar or just point of sale kind of things.
Yeah, Michael, and maybe you want to speak to the kind of the idea of economic nexus and how it applies to some of these concepts.
Yeah. So there's a couple different factors at play here. Usually, wherever you have any sort of physical presence, there's going to be some sort of taxing obligation, whether it's income tax or sales tax, and usually some sort of physical presence is going to trigger some sort of tax filing requirement. Marcus just mentioned economic nexus, and this is probably a bit of a detour, but it is I think a valuable one. Right now is probably one of the most complicated times to be doing business in the United States, honestly. There was it was actually a United States Supreme Court case that came out a couple of years ago called Wayfair. Some of you might have heard this. It was actually at issue was the company Wayfair, the online seller, and a sales tax statute out of South Dakota. South Dakota basically was imposing tax on the sales into South Dakota, and Wayfair had no physical presence whatsoever. And for many, many years previously, under U.S. Supreme Court precedent, if you did not have a physical presence in a state, states were restricted from imposing sales and also income taxes on you as an out-of-state taxpayer. And South Dakota, the case went all the way up to the U.S. Supreme Court case, and the state won. And it created this concept now that we call economic nexus. The way the statute read was, it kind of gave you a bright line test. If you are selling above a certain threshold into their state, even if you're an out-of-state seller, no physical presence, they can impose a sales tax on you now. as you can imagine, within very short order, all the states started enacting Wayfair style statutes or statutes a la South Dakota's. So now we've got this concept of economic nexus, and it's really, really creating a lot of uncertainty when it comes to sales tax in particular, also income tax, because economic nexus isn't just a sales tax issue. It can also apply for income taxes. So two things, I always tell companies. Number one, wherever your people are, if you've got an employee, whether it's Tennessee or New Hampshire or Florida, understand what the taxing regime is from an income and sales tax perspective in those states. Anytime you have an employee or maybe even a contractor that's doing business on your behalf, need to understand what your sales tax requirements might be. Also, number two, look at where you're selling. Even if you don't have somebody in those states, where are you selling on a state-by-state basis? Understand if they do have economic nexus thresholds, what those thresholds are, if you're above them, and if not now, when you might be above them to make sure you're getting ahead of it.
Do you know where you find that information, Michael? Like, is there one website that has all of those states listed as far as
I wish there was. Here's part of the problem. It changes so frequently. I usually recommend looking at the actual state websites. We have a tax practitioner database where we can generate what we call smart charts that gives you a quick rundown of a particular states or all the states' taxing regimes. Very high level. We could certainly circulate that, but I always recommend looking at the individual state websites as well.
Okay.
And one other thing I do want to mention, I'm based in Colorado, and Colorado, for example, is one of the most difficult states for sales tax purposes. And this is not uncommon, but you'll have states that have state level sales tax, but then we'll have the local component, right? Which is pretty common. A lot of states have that. But Colorado has what are called home rule jurisdictions, and other states have this as well. And a home rule jurisdiction means that, hey, we do not follow the state rules for taxing a particular good or service. So you might have a product or service in Colorado that is taxable at the state level, but not taxable in Denver County, let's say, or vice versa. So not only do you have to worry about the state level taxing your particular good or service, but also the local jurisdictions, how they view it, how they tax it. So, there are a lot of companies out there now. You probably have heard of Avalara. They're good. They are a service provider that will basically take care of your sales tax filings. And I highly recommend, even if you're just getting started, just starting to have your first sales, get ahead of sales tax. It's worth the investment. Whether it's CLA or Avalara or an attorney, make sure that you're consulting with some sort of practitioner that can guide you through the ever-changing landscape of sales and use tax. Oh, I see. Actually, somebody mentioned
we've got one
Avalara
more
here. Yeah, Avalara or TaxJar. I'm not familiar with TaxJar. Avalara we know very, very well, and yes, I think Avalara. I'm not in it on a daily basis, but I know we as a firm kind of consult with Avalara and clients that use Avalara, and I think for the most part, it seems to be a really good platform. I think there are certain companies, certain types of companies that might outgrow Avalara at some point, but I think for especially early stage companies, it's a really solid platform.
Yeah, good. Thanks, Michael. So Amir, we've got a question from you here about being headquartered outside of a state that you operate in. Again, it's kind of going to be on a state-by-state basis, but if you've got, so you're saying if you're established in Nevada but operate in California to pay California tax, state by state, this is going to vary, but I can tell you California is one of the most aggressive states in the nation in terms of pursuing folks who are conducting business activity in their state, right? So it's going to depend somewhat on the level of your of the business that you're doing, you know, on a state by state basis. But certainly I would say don't assume you're not subject to a state tax just because you're not located in that state. If you're conducting business there, we would definitely advise you to have a look at that state specifically and make sure that you understand the rules.
Yeah,
Does that
and
help?
I think as a result of Wayfair, guys, you know, previously we would have defaulted, no, you probably don't need to file if you don't have a presence there. Now I think that kind of, you know, equation has flipped a little bit. I think it's presume you're taxable until you find out that you're not. And one other thing to remember, guys, is, you know, you might technically have, let's say, an income tax filing requirement because you have an employee. That's going to amount to zero tax due, right? So let's say you're generating a loss at your business. Chances are you're not going to have significant tax liability in a state. Now you might have like a gross receipts or franchise tax.
Or franchise tax.
Yeah, exactly. Where you might have a couple bucks due. But a lot of times you might technically have a filing requirement in a state that you might make the business decision not to file there for whatever reason. You know, we just brought on a new client out in the Denver office, brand new company. They're a manufacturer. This is year one, and we're trying to get their filing footprint down. And, you know, their fact pattern was in analyzing where they have people, they had somebody in New Hampshire for a couple months. We looked at it and said, yeah, you probably should be filing, but the person's not there anymore. You don't plan on having anybody else there. You don't have any, you know, sales right now in New Hampshire. So probably not a big deal if you don't file in that particular state from an income tax standpoint, you know? So a lot of times we'll advise like, hey, here are the rules, here how they align with your fact pattern, and let the client make the business decision as to whether or not you want to file.
Yeah. Thanks, Michael. I'm getting a bunch of messages in the chat about copies of the presentation. I know Joel had a little bit of a special circumstance, I think, so I went ahead and fired him off a copy, PDF copy of the presentation, but this will definitely be available at the end to everybody. So you don't have to send me your email. I think Parker's got the email addresses, and we'll make sure that everybody gets a copy of this when we're finished with our conversation today. So.
Yeah, that's right. After the event, I'll send out an email to everybody with the PDF to it, so we can just worry about that then. But thanks, Marcus.
Yeah, you bet. Looks like Debbie has a question. Debbie, fire away.
Hey, sorry I'm late. I was on another call. I don't know if you can answer this, but I jumped on here, just maybe you can. So I started my business. We're a tech startup. We're selling subscriptions online for hotels and venues to be able to digital market. I don't even know what I'm supposed to do, what taxes on that, but right now everywhere I've read is that's not taxable. So I'm going with that, and we don't have a lot of sales. I did make a sale this week. I haven't collected the money on it, but I'm still on unemployment. I don't want to lose my unemployment for one tiny little sale. So do I have to record that as income, because a lot of it is passed through? So I am collecting, but I have to pay a videographer, and then I have to pay my developer on top of that. So I'm not making any money off of this sale, but I don't want to lose my unemployment over one little sale.
Yeah, go ahead, Michael.
How are you set up, Debbie? Your company, are you an LLC?
I'm an LLC.
Okay, is it just you?
Yes.
You're the sole owner? Okay. So I would say that with respect to the sale that you made, that income, yeah, you do need to pick that up. You know, that's gonna, so you'll file something called Schedule C on your 1040, which is gonna report the activity for your business. However, you'll be able to offset that income with all of your expenses. You know, all the, you know, necessary business expenses that went into generating that income, you're going to be able to likely deduct that. So you might end up really with no taxable income, once
Right.
all is said and done, you might end up with no taxable income, even though you did have to recognize the sale. So, once that flows through to page 1 of your 1040, it might be a negative amount, in which case, I think you mentioned unemployment. Did I hear that?
That's kind of my biggest problem is if I collect this money, I have to go on my unemployment and say I made money.
Well, and
I
that's
lose
going
my
to
unemployment.
it's going to depend a little bit on what your specific rules are with the unemployment office, right? I mean, have you done some checking with them to see what they would consider to be income, right? It's not like you earned a wage.
No, I haven't. I was so scared to call them to like open up a can of worms here without asking someone.
Yeah,
first.
so I mean, a lot of times you've got these call centers, right, where you can call in more or less anonymously and ask a question like that. And it was me. That's probably what I would recommend you do, just to kind of know where you stand, and then easier to make a decision from there. Michael, what do you think?
I agree. Yeah, I agree. I mean, when in doubt, call or engage a professional. Calling is easier said than done a lot of times with any sort of governmental agency.
Yeah.
But, I don't know the ins and outs of how they determine eligibility for the unemployment side of things. If that, if they look at things on the net basis. And my guess is,
and I don't either. I mean, I think probably could dig into the rules around the unemployment specifically, or you could engage somebody to do that, and probably could get that answer without calling if that's something you're not super comfortable with. But unfortunately,
it's been very confusing because you lose your full-time job and then you start something. And I'm applying for jobs, like I can do both, but you get your first sale and you get really excited, but you're like, oh my God, I could lose my unemployment completely. And is the sale right now worth it? And I hate to say that, but
generally there is a threshold of some kind with regard to earnings and unemployment, generally speaking. Again, not knowing the exact specifics of your situation, but I think that's unfortunately that's about as good an answer as we have for you at the moment. So
one other thing. One
ahead,
other thing I want to mention real quick, guys, and I don't know if we have this in the slides, is we're spending a lot of time on income tax and sales tax. Don't forget about payroll tax, especially if you are going to have employees, or if you have employees now. Make sure that you are getting set up for payroll tax, and this is at the federal level, but also states. A lot of states have some sort of withholding requirement as well. Tennessee, though, I think doesn't have the personal income tax, if I remember correctly.
No personal income tax in Tennessee. But yeah, certainly from a federal standpoint, and I think I did not end up putting that in the slides. But you do have a Tennessee. You would have Tennessee unemployment, obviously. Yeah. You're certainly going to have the federal taxes. The federal taxes, when you go to apply for an EIN, a federal ID number, they're going to ask you the question, right? They're going to be like, hey, do you intend to have employees in the future? Sometimes you it's a timing thing, and you'll want to say, yes, I do, if it's pretty close. But once you tell them you're going to have employees, they're going to start asking you to file forms, even if there's zero. So that's something to keep in mind. You can always go back and revise your registration with the IRS and add those payroll taxes on later if you want to. But Michael, that's a great point. Definitely don't want to overlook payroll taxes.
Yeah, and huge word of caution: if you find yourself with employees down the road, filing 941s or 940s, make sure whatever you do that those deposits are happening. The IRS, one of the most aggressive areas you'll see with the IRS is payroll taxes, and specifically taxpayers that do not remit or do not timely remit the federal tax deposits. So big deal. Easy way to get sideways with the IRS.
Yeah, that's exactly right. I mean, there are plenty of payroll services out there that will take care of this whole thing for you. And probably our best advice is, engage a payroll service, right? Man, they know what the rules are. They're going to make sure your deposits happen on time, no matter what jurisdiction you're talking about. Couldn't hardly spend your money any better, because like Michael said, you just don't want to get in arrears in that kind of a situation with payroll taxes. So thanks, Michael. That was a great addition. Got another question here. Best type of consulting service in terms of forming a small e-commerce business. We're probably biased because we're a CPA firm, right? But I mean, I think a CPA, engaging a CPA is going to give you a pretty well-rounded approach to consulting about what your small business needs. There are times that you're going to need an attorney, right? Because there are things that CPAs can't and won't do for you, and in terms of consulting with regard to risk, business risk specifically, or some other issues, but generally they're pretty good about knowing what it is that they can and can't say as far as consulting goes. So yeah, I think consulting with the CPA is a good idea. Okay, I'm gonna move us along here quickly. Again, really great conversation, and frankly, guys, this is what's fun for us. I mean, we can spit information out at you, but it's a lot more fun to take your questions and engage on specific issues that are important to you. So keep them coming. I hit on property taxes here. This is an often overlooked kind of area of taxation, where essentially you've got counties that will assess taxes on the value of your business property. I'm talking the physical, tangible stuff, right? You've got your computer equipment, even, and this is just one that people overlook. So you can go click the link, check it out, see if you're subject in your county or not. But that is something to just kind of be aware of. It's generally a very low tax rate on property taxes as well. So it's kind of the equivalent of the real estate tax. I mean, that's also technically a property tax that they levy against homes. I'm sure you're familiar with that. But property taxes are kind of the equivalent for a business. So, okay, moving into the realm of what in the world is an accounting system, and which one would I use, and what do I do with it once I have it? I think one of the biggest things that we could recommend is there is technology out there, great technology with regard to collecting and categorizing your business activity. Use it, right? We talked about having a business bank account. Think that's a good idea no matter how large or small your business is. If for no other reason, it gives you a great way to be able to look at a single place and say, and this is the account that I had money coming into and money going out of. You can always, log the personal ins and outs. A lot easier to pick those few things out of a business bank account than it is to sort through the personal financial data and say, oh yeah, this was business and that was business. So we'd absolutely recommend a business bank account. And if you've got one of those, you can hook it up to one of these accounting platforms. QuickBooks, Xero just happen to be. There are others. These are probably two of the more high quality ones. They're the ones that CLA supports through our BizOps team. There are some really good deals on the software. We can be talking about, in some cases, less than $10 a month for a really simple business, just to be able to suck the bank account data in and categorize it. So really highly recommend that you consider using an accounting platform to keep track of your business activity. You might say, gee, how do I classify my revenue and expenses, right? And our advice is keep it simple. I gave you a link here to the IRS Schedule C. You heard Michael reference that. A Schedule C is what you'd file if you were a sole proprietor, and even if you've got an LLC and you're just you. It can be disregarded entity for filing purposes. You can just put it on your Schedule C. What I like about the Schedule C is that truthfully, a lot of the reason we keep track of our income and expenses ends up being so we can file our tax returns, right? And so use the IRS categories that they put on that form as a guide for things you definitely ought to track and categories you definitely ought to use. And then, if you're going to your CPA to get your taxes filed once a year, they can help you clean up and if you're looking to retain a CPA or another advisor, they can help you get it a little bit more nuanced. But that's a great place to start if you're just getting rolling and you just want to get this thing going on your own. I threw in one more comment here, which is just understanding the difference between a variable expense and a fixed expense. Okay, so a variable expense is an expense that's going to increase as your revenue increases. So think about making widgets, right? The materials that you buy to make those widgets, the labor that goes into those widgets, it's the amount of the materials and labor is going to increase as you make more widgets to sell, right? Or as you sell more widgets. Fixed expenses, things like rent are probably not going to change a lot, or at least they're not going to change at the same rate as your sales volume, right? So there's just a couple of real simple examples. And again, what you're going to see mostly on this Schedule C is examples of fixed expenses. There's a single line for cost of goods sold, or maybe a couple of lines for materials and labor. So, Michael, before I move on from that, anything else you would add?
I don't think so, Marcus. That's good overview. Don't run your personal stuff through your business bank accounts. Just
Please.
Don't do it ever. Yeah. The other thing I would mention, more from a tax standpoint, guys, when you are kind of day one starting your business, really keep track of those costs there, because there are some special rules around startup costs when it comes to deducting those expenses. You might have to capitalize some of those expenses for tax purposes. So it's really important that when you are, setting up your LLC, maybe engaging an attorney, those kind of, upfront costs, really keep track of those, because there might be some special tax reporting nuances to those startup expenses.
Yep, absolutely. So even if you got to just write those down, if you're spending those out of your pocket before you open that business bank account, just make sure you keep a list of them, and your tax professional can help you make sure those get treated properly. Okay, moving on to answer the question, what if I want to create a forecast or a budget? How do I go about doing that? And what I've tried to do here is put together a real simple slide of something I call bottom-up budgeting, right? So a lot of times people try to start their budgets at the top, all right? And they're like, well, geez, I'm going to generate $1 million in revenue, and this is what it's going to cost me to do that, and then I'll deal with my fixed expenses. But if you want to know what you need to do in year one, right? A good way to go about this exercise is to say, okay, I need X dollars in profit in year one to pay for investments in equipment, to make payments on debt that I might have incurred to get my business going, and maybe to pay myself, right? I need this much profit. And to that amount of profit, I'm going to add my fixed expenses, my rent, my utilities, my phone bill, my liability insurance, my vehicle expenses, whatever those fixed costs are. If you add all of that up, what you can do then, what that's going to get you then is to this gross profit or gross margin number. Okay. And then what you can do is you can go about figuring out what kind of revenue you need to generate in order to cover that gross margin, if that makes sense. So it's a way of kind of working from the known to the unknown. And then you can stop and you can ask yourself, is this feasible? Like, can I actually manage to generate this kind of revenue? Or do I need to take another look at my business model? Or, hey, can I just not make money in year one? And what that would tell you then is you're going to need to go and find some source of dollars, right, to support you as you ramp your business up to the point where you can make it profitable. But I like to advocate this way of going about that initial budgeting process, just to help you test feasibility a little bit. And then one other thing that I'll mention, a lot of folks in the startup space, and particularly in the software space, are looking to raise capital, right? You need to do some sort of a capital raise to kind of take your idea to the next level. And something that we like to advise clients to do is really be clear when you're developing your estimates of the revenue that you think you're going to generate. Don't just say, I'm going to sell 30 widgets at $20 a piece. How did you get to 30 widgets? What work have you done to figure out that you can sell 30 widgets in year one, right? Because when you go to raise money, if you've got assumptions, the folks that you're going to raise money from, they might not like your assumptions. They might think your assumptions are wrong, right? But it starts the conversation around, again, feasibility. If you just simply throw the revenue out there as kind of blue sky, then that gives them it could put you in an uncomfortable spot of not really knowing how you got to your numbers. But two, it gives them the opportunity to really kind of establish the assumptions for you. And you want to be in the lead on that conversation, right? You know your business, it's your idea. So an example that I've heard used is if you're starting a lemonade stand, right? You don't just want to talk about the 10 cups of lemonade you can sell for $5 a piece. You want to talk about the traffic that's driving down the street, right? You want to talk about how many of those cars are going to stop to buy a cup of lemonade, right? Those kinds of things are the assumptions that underlie your revenue, and you want to give that some thought. So just again, I don't want to spend a whole bunch of time there and get super long-winded, but if you're looking to just get rolling on doing some budgeting and forecasting, this is a model that you can follow and hopefully get something pieced together. So Michael, anything you would add to that?
No, sir. Great job, Marcus.
Okay, great. So we got just one more slide here. This is a little bit of a complicated area. I wanted to throw it in because it is something that comes up in startup land. And so Michael's going to do this, and then we've got about 24 minutes of our time together here remaining. And so Michael's going to give you a quick blurb on incentive compensation, and then hopefully we can have a few minutes left to take whatever other questions you've got, whether it's on the topics we just covered or the stuff we were talking about earlier. So Michael, take it away.
Yep. And guys, we'll keep this very high level. This area can get fairly complicated. It's always something you really need to consult an attorney and an accountant on. But one of the considerations as you grow, as you start bringing on employees, is how the heck are we going to pay them? A lot of early stage companies just don't have the cash to pay a market salary. It's the reality of things. So over the last few decades, more and more companies have turned toward equity compensation. And there are a couple different flavors, but they all essentially try to do the same thing. And it's to incentivize talent to come on board, to stay on board through an ownership slice in the company. That's really what it comes down to. There are a few different types to think about. They all kind of have their nuances. Some are easier than others. Some are only available for corporations. But as you grow, as you look at, attracting, retaining talent, chances are you'll have some sort of incentive equity comp pool in your company. Now, the kind of basic stock option really came out of Silicon Valley many, many years ago. It was kind of born with tech startups decades ago, this concept of stock options. And from there, they've grown quite a bit. They've become more elaborate, more complex. And also we kind of have different derivations of the original stock option concept that have also come about. But these are really four big areas for corporations when it comes to equity-based comp, those four that we listed here. ISOs, incentive stock options, those are usually the most favorable to the shareholder, right? This is, well, actually, let me take a step back. Very, very basic terms, a stock option really is not ownership of anything other than a future right or current right to exercise your exercise your right to get a share of the company in hand at some future date, really. So an option doesn't really give you a current ownership interest in the company. It says, hey, you keep performing, you stay employed for the next 2-4 years, you're going to have the right to buy a portion of the company. It's really as simple as that. So ISOs are probably the most taxpayer friendly. They are pretty tax neutral up until you sell the shares down the road after you exercise. But ISOs have become, they've kind of fallen out of fashion a little bit because there's some very strict holding requirements that you have to meet. And it's for that reason that some corporations have kind of turned away from incentive stock options and replaced them with the next one, non-qualified stock options. They don't have the same holding period requirements as ISO. So see a lot of companies that have really turned toward these non-quals, as we call them. You also have restricted stock awards and restricted stock units. Kind of similar in that they don't really give you an immediate ownership stake in the company. They're tied to some future event, continued employment, where you will vest and be able to exercise your right to the award or unit. And sometimes with restricted stock units, you might be able to settle them in cash. It's not necessarily a share in hand you're going to get. You might get the cash equivalent in that future year. So the article that we pasted there gives you a really good overview of how these different mechanisms work, what might be right for your particular company, if when you are going to create some sort of incentive comp pool. One big area you need to think about, though, and why it's so critical to consult with an attorney and an accountant is these kind of ancillary tax provisions. We have 409 Cap A and then 83B. Not going to bore you with what these are, but they're very important. And 409A in particular, if you are not in compliance, there could be penalties. So anytime you're looking at really non-quals and any sort of restricted stock awards, really need to look at 409A to make sure that your plan is drafted accordingly, because you do not want to get hit with any sort of 409A valuation. It's a big deal. 409A is a very complicated provision. It came about in the mid-2000s, and it really sets forth a very complex set of rules for deferred compensation. And some of these equity comp arrangements are considered deferred comp for 409A purposes. So look at the link when you get a chance. Hopefully you find it useful. Again, it's kind of high level overview, but it'll give you the nuts and bolts of what these different equity comp plans mean. These are really for corporations, you know, anything related to stock options and stock awards and units. Really, those are corporate concepts. For partnerships, you do still have the ability to incentivize folks with equity comp, but it's going to take on the form usually of what's called a profits interest. So it's basically saying, hey, you only get to share in the future profits of the partnership. Usually you're not going to have an ownership in the underlying, you know, capital or assets of the company. It's just going to be a right to those future profit streams. Those can be very attractive if you are operating in the partnership form and you want to stay in the partnership form. Issuing profits interest have become very common. A lot of times what you'll see is, especially in some sort of transaction, you might have an operating entity. You'll create a new LLC on top that you're going to issue your profits interest out of to incentivize your talent. One thing to keep in mind, though, with a profits interest, you essentially have to treat those individuals as partners. So they'll have to get a K-1 going forward. Once they have a profits interest issued, they are effectively treated as partners for tax purposes going forward. So hopefully that gives you at least a very abbreviated overview of some things to think about down the road when you are looking to bring about some sort of incentive comp plan for your people.
Yeah, great. Thank you, Michael. And that really brings us to the end of the slides. I didn't drop Michael's number in here. Before we send you the presentation, I'll drop his number in there along with his email address. I'm also going to add a section just to quickly address, as a reminder, the payroll tax question that Michael brought up, and make sure you've got a resource to look at there as well. But that's really what we had prepared in terms of slides. We've had some good conversation. and happy to have more here. We've got about 15 minutes, 16 minutes remaining of our time. So really, if you've got questions, now's a great time, and we'd be happy to answer them.
Yeah, one last thing I'll add, Marcus.
Great.
You know, we talk to a lot of early stage companies that are going through, you know, an incubator, an accelerator, and I like to end with the following. This stuff is hard, you know, like you have your idea, and, you know, I give you guys so much credit for bringing it to market and, you know, really putting your blood, sweat, and guts into something that, as you know, might not ultimately succeed, unfortunately. And this stuff is hard. It is worth the investment of time and money, though, to get it right day one. It is much easier to get it right out of the gate than have to go back 5 years from now and fix this stuff. When you're creating your startup company, you've got your idea for innovation. Taxes, accounting might be the farthest thing on your mind. You're thinking about, well, shit, how am I going to get my first sale, right? But this stuff, don't ignore it. The sooner you can address it, the better. I guarantee you'll be much better off for it 5 years down the road. With that, with that kind of, you know, word of encouragement, but also slight word of caution, look forward to questions here.
Yeah, thanks, Michael. We've got one about the Simple Startup Llc. Yeah, and I think Michael touched on this earlier. I'm not, you know, not affiliated with LegalZoom, but something like that for a very simple LLC to start up, probably a good way to go.
Totally agree. Yeah, I have no issues with LegalZoom. They do a good job, and LegalZoom, you know, they have actual attorneys on the other side of the computer, if you will. You know, they have to. So, yeah, I think LegalZoom, especially for a basic LLC formation, probably getting an initial operating agreement as well. I think LegalZoom is just fine. Yeah.
Great. Other questions?
Have Carissa's asking Zen Business. I don't think I've heard of Zen Business.
And I haven't seen it either.
Yeah, I'm gonna look them up here as we're chatting. And Carissa, is that one you're exploring currently, Zen Business?
So I've looked at both. They're pretty comparable as far as cost and what they offer. It just seems to have a lot better reviews as far as customer service, as far as questions and things like that. Obviously, LegalZoom is much more well known and has a lot of customer base, a larger customer base, but I was just curious, like, honestly, like, if it even really matters. Like,
probably not. I mean, yeah, this is for your initial LLC formation. Is that right, Carissa?
So basically, I have like a startup that I'm trying to learn the processes of, like, just starting a business and understanding that failure is going to happen. And so I'm kind of using a small, like, kind of tester business just to kind of learn the ropes. So I don't want to invest a lot of money only just to learn for plans of, like, a more intentful startup in like a year or two.
Yeah, fair point. Yeah, I would say if it looks legitimate and there's decent reviews, you're probably going to be fine using it. And there are other ones out there now. You know, LegalZoom kind of started the field, but there are many others out there now. I know there's Nolo, there's Business Rocket or something like that is another one I've seen recently. But I think they're all probably legitimate. And for simple LLC formation, you're probably fine using any of
Do you mind if I ask just one more question? I don't want to
go ahead.
When it comes to filing as like an industry, I know like LegalZoom requires it. If you're doing solely e-commerce, it's just the e-commerce industry, but do you know what it would be technically called if you're also doing like point of sales, like in like a brick and mortar or, you know, like at a farmer's market or things like that? Is there like a industry type that covers both e-commerce and like in-person point of sale?
I mean, retail is probably the umbrella, right, Michael?
I wasn't sure if you could.
Just to confirm, Chrissy, you mean for industry classification purposes?
Correct. Yeah.
Yeah, probably you could use retail. Honestly, I feel not a lot of people pay too much attention to the industry
Okay, I wasn't
classification.
sure.
Fair.
Yeah,
I
I think if you
make the wrong
find
decision.
something that smells remotely close to what you're doing, and you're probably okay.
Really?
Yep.
Okay. It would
Yeah.
probably be like 99% e-commerce because it's a Shopify, like I mentioned earlier, but
Sure.
I don't want to limit myself. If I put that, like, I didn't know if you are still able to do like in-person point of sale, like retail sale.
Yeah, I think you'd be fine.
I would as well.
Awesome. Thanks, guys.
Yeah, you bet.
Thank you.
Got about 11 minutes left here, 10 minutes. Happy to take any other questions in person or in chat. Either one's fine.
All right. Well, I mean, if there's not any more questions, we can end it right there. Unless there's anybody last chance for any more questions. Anybody? All right. Well, Michael, Marcus, we really appreciate y'all doing this today. That was great. I think everybody got a lot out of it. I look forward to maybe doing this again sometime. So yeah, thank you so much. And
absolutely.
Yeah, if y'all have any last words, go for it.
No, we're super happy to be partnering with the EC to provide value to the startup business community in Nashville, and you'll have a copy of the presentation. You'll have our contact information. Please don't hesitate to reach out if there's anything CLA can do to help. So,
Hey, Marcus and Michael, are y'all part of the EC Advisor Network?
okay, I am gonna have to. Yeah, I think that is the case, Chris. I know there's a number of ways to be involved in the EC, and I want to say we talked about being a part of that, and I cannot remember honestly. We've got a couple of us on the Nashville team working on it, and I don't know for sure. Parker, you don't happen to know, do you? Oh,
I can't hear you.
Yeah, I'm not hearing them either.
It's okay. I'll just take a look. I'm in the pre-fight program right now, so I'll just look and see.
Yep. No, that's fine. I think that we might be. I'll actually write it down as a note to find out what our status is there. But
awesome. Thanks.
Yeah, you bet.
Okay. Can y'all hear me now?
Yeah.
Sorry about that.
No worries. Oh, we got one. Somebody just popped a question in here having to do with international business and R&D. Michael, I think that one's yours.
That is all me, Amir. Ask away, and I'll hopefully have an answer for you.
Gotcha. You can hear me, right?
Yep.
Yeah.
So I had one quick question regarding to how tech businesses, like a lot of them, I'm sure you're aware of it. Like a lot of tech-related businesses, like Google, Apple, they'll like set up subsidiaries outside of the states and then make it to where they like those subsidiaries have licensing, like have the licenses to softwares or whatever. Yep. And then like their operations here pay them like outside of the states in order to reduce their profits here and reduce their tax liability here. Are you familiar with any of that?
Oh, very much so. Yeah. I think the incentive to do that was lessened a little bit as a result of tax reform a couple of years ago. Some of the changes they put in play was really to try and curtail some of that practice. But what you're talking about has been a long-standing practice with large, the large tech behemoths in particular. They'll go set up a Luxembourg subsidiary or a Swiss subsidiary. They'll migrate all their IP over there. And yes, I mean, it was really at the end of the day, they might say otherwise, but it was really with an eye toward lowering their U.S. tax bill. IP migration, it's commonly referred to as, it's, I would say it's very, very, it's relegated to the larger tech corporations of the world. And again, I think it's kind of fallen, I think maybe a little bit of, it's not as attractive as it was since they brought down the US corporate rate and also allowed kind of like a one-time repatriation as part of tax reform in order to get companies to, keep the money in the US and not go through those, maneuverings to lower their US tax bill.
Gotcha. And are you aware of like that Puerto Rico tax incentive, like that Act 20, Act 22 at all?
No, not specifically. What is it, Amir?
So what I've read is if you set up an LLC in Puerto Rico, which is a province of the US, they reduce your tax liability, or like your business taxes are reduced up to like your corporate business taxes are reduced to 4%. And if you're out of the States for 6 months, what I read was like you're not taxed on capital gains either, as far as that.
For interesting. No, I had not heard of that. I admittedly don't do much international tax work, but it is interesting, and something I will definitely run by. We have a fairly decent size international tax group, and if you'd like more information, we can certainly get you some. I'll look at it, really out of curiosity, because I had not heard that. But yeah, thanks for bringing that to my attention.
Yeah, for sure. And I'll have like access to your number and like email.
Yeah.
Okay, cool.
Yeah. And one last thing, since we're talking about R&D and international expenses, this is something, given what the tech flair we have here with you guys, there is a change that is likely, potentially, I should say, coming down the pike effective January 1, 2022. And it revolves around deduction of research and experimentation costs. This is a provision of the tax code called Section 174. And for many, many years, and really going back to the 1950s, the general rule was that if you have research type costs, you can fully deduct those current year. Part of tax reform, though, was a change to those rules. And right now, the way the law stands is that effective January 1, 2022, you are no longer going to be able to fully deduct research and experimental costs. This is something that is going to impact software companies quite a bit. So you will not be able to fully deduct in year one. You're going to have to, in the case of US research and experimental costs, amortize over 5 years. But very significantly, in the case of foreign research, now they're going to have to be amortized over 15 years. This is a really big deal for software companies that offshore their development. So going from enjoying current expense treatment to now having to capitalize and amortize over 15 years is a big deal. There's a chance it might not actually go into effect. There's actually a bill out there right now, just introduced last week, I think, that would effectively restore Section 174 to what it was prior to tax reform. Just something to think about. If any of the folks on here, you do have any sort of research development costs, specifically foreign, this is something to think about and follow.
Hey, Marcus and Michael, this is Donna from the EC. Hey, I was just, when I think it may have been Carissa who was asking if you guys were on the advisor group yet. First, we want to thank you and CLA for being our newest partner at the EC. You have already have a wonderful presence. And yes, team, CLA will be part of our advisor group. They're brand new, but right now we're getting everything set for them. So if you want to reach out to our CLA team, just feel free to email me. I put that in the chat. And I'll connect you with our team, our CLA team.
Perfect. Thanks so much, Donna.
Awesome. Great.
Well, Michael, Marcus, thank you so much for speaking to us. We really appreciate it. And yeah, we hope that we can do this again. And again, y'all reach out to Donna if y'all are trying to get in touch with CLA. Thanks, Michael. Thanks, Marcus.
Thanks, everybody.
Thanks, everybody.
Thanks so much.
Have a great day.
Yep, y'all too. Bye.
Bye.